Today, ladies and gentlemen, we're diving down into the Bank of Canada, which is going to be raising interest rates tomorrow, September 7th, expected to be about 0.75 basis points. We're going to take a look at how this is going to be affecting Canadians. Is this going to devastate the market? We're going to be dividing this into some individual stocks that I think are going to be able to take real advantage of this in the coming future, and along with savings accounts, GICs, and how I'm utilizing this through my own personal finance. And if that is a conversation you can appreciate, come on guys, man, do the channel a favor here. I'm back, baby. Hit that like button and let's get into this by taking a look at the historical interest rates. First and foremost, I mean, this is pretty astounding to think that this is what's been jarring the market. We've talked about this before, but we're sitting at about 2.5% from the base rate right now, and 0.75 basis points is going to take us just over 3%. Historically, something we really haven't seen since about 2008, and we're all suspecting that they could raise it more into the future, but because inflation is cooling off pretty dramatically, you're seeing it at the pumps, you're starting to see it at the grocery stores, things like that, guys. This will probably be the last interest rate hike. I think, honestly, when this relates to real estate, that likely we're about to see the bottoms in the real estate market, largely through the collapse we've recently seen of upwards of 20-30+% in given areas. And that just comes down to the fact of, you know, things are balancing out here, guys. We're starting to see the end half of the insanity when it comes to inflation. But what does this mean for households? I mean, obviously, if interest rates are going up and you're already in a mortgage, that could be trouble, especially if it's a variable rate mortgage. But there's a lot of things in tandem here that I find very interesting. Tal, a CIBC executive there, has started talking about some of the statistics they took from basically Statistics Canada. And this is very intriguing because this is from August the 22nd report. And it basically says the author notes in the report that 30% of Canadians are completely debt-free, meaning a more expensive borrowing rate won't affect their payments at all. So 30% of the entire economy is basically cushioned from these raising interest rate hikes. Now, many people with debt don't actually have a mortgage, meaning their household debt comes from credit cards or loans to finance a new car, for example. And credit cards, their rates don't really go beyond 19.99%, which is my current rates, but we can see, but credit cards already have a very high interest rate, making the impact of the Bank of Canada's rate hike largely negligible. Tal argues and installment-based loans usually have steady interest rates through the length of their terms. So that just leaves mortgage holders and homeowners who take out home equity line of credits or HELOCs on their property to feel the brunt of their hikes. Now, my line of credit, personally, I've seen the interest rate go up pretty dramatically month over month. I think I used to have it around 3%. I haven't looked lately, but last I did, it was like 5 or 6. But those with adjustable rates are certainly feeling the effect of higher rates as the amount they pay on their mortgages increase immediately when the Bank of Canada hikes its policy rate. That's the case for interest rates on HELOCs too. But 70% of Canadians with variable rate mortgages are on fixed payment schedules, meaning they don't pay more each month when their rate rises. Instead, the amortization or the overall length of their mortgage term extends. And just kind of continuing on a little bit farther here, Tal says that since 5-year fixed rate mortgages are dominating Canada, most monthly payments are holding steady through this rising interest rate environment. Homeowners on fixed rates will only feel this sting of higher rates when they renew their mortgages in a few years. In a few years' time, he says. That means that for this year, it's only 1/5 of fixed rate mortgages exposed to the interest rate hit, along with those adjustable rate and HELOC holders. Putting it all together, baby, they're basically saying that we get that out of the total household debt of $2.7 trillion, close to $650 billion, or 24%, face actual increases in the payments this year, which basically the report reads. So in the grand scope of the Canadian financial system, this is not going to be the end all of the next great depressions here, folks. If anything, the news has really been over-exaggerating how bad this is. And again, there's a lot of existential fears when you're talking about geopolitical events. But at the end of the day, guys, if inflation continues to cool off, you know, it's going to be a nominal market kind of moving forward, I think, for the next 3, 6, 12 months. But I think we're really starting to see the final cushioning, where we'll probably start seeing a leveling off, which I'd largely say we're seeing in the stock market. I know Michael Burry's saying, hey, we're seeing another great financial crisis. It could still fall 50%. A lot of people saying that. I have a hard time believing we're going to get there, but notice that a lot of people are pulling investments out of the market, investments out of precious metals, and they're looking for these guaranteed returns with GICs and bond rates and things of that nature. And I'm expecting that after tomorrow, we should see another hike in the actual savings account rate. I remember you go back literally several months ago and you could only get like 0.5 at the highest percent on a savings account, and now we're at like almost 2.5%. It would be really nice to start seeing this get closer to 3% after the next hike. That would be absolutely phenomenal for my emergency fund. And then of course I'm going to be very fixated on GICs, which already you can get anywhere from 3 to close to 5%. The highest here is about 4.65%. And honestly, if these start, again, everything gets closer to 5%, the basic savings hits 3%, I'm going to be very ecstatic, because I'm obviously going to be putting some of my emergency fund, some investment capital toward this, which again is another reason that we might not see a crazy bull run in the markets, because people that chase dividend stocks, especially where they're chasing REITs and some of these things that yield 3 to 5%, I'm going to say, they might see that it's a better allocation of their capital to have real true security and a guaranteed investment that doesn't have any volatility risk than buy stocks. But I'm still looking at stocks, and what I recommend you do, not financial advice, so what I recommend that I'm going to be doing is really investing into the bank stocks. These bank stocks I've traded down pretty dramatically. I mean, take a look at this. Royal Bank year to date's down 10%, Bank of Nova Scotia's down 7%, Canadian Imperial Bank's down 20%, TD's down 17%, and they're all yielding upwards of 4 to 5%. And these banks, Bank of Nova Scotia is one that I paid a lot of attention to on their earnings call, because at the beginning of the year, stated this many times, that they said they were going to initially be impacted by a slowdown in people taking on mortgages, things of that nature, as people get cushioned into the new interest rate environment. But as it nominalizes going into 2023, they expect to actually see further continued growth because of the raised in interest prices, because then they make more money off line of credits, these HELOCs, new mortgages, things of that, right? So I honestly think at these discounted prices with these much higher starting yields, if you are looking for the guaranteed investments, you're looking for some dividend and cash flow, guys, this is the real opportunity. And the only way I'm taking advantage of this is through the Vanguard FTSE Canadian High Dividend Yield ETF, which overweights bank stocks by like 60% or something like that. I mean, just take a look at this. Royal Bank, Toronto Dominion Bank already make up 20, 24, almost 25% of this entire ETF. You've got Bank of Nova Scotia at 7%, Bank of Montreal at 6.22%, Canadian Imperial Bank at the bottom here, guys. And then you get some of the energy stocks, which have been a good cushion to the general environment. I think even in this, even in the market right now where energy is cooling off, I still think some of these stocks like Enbridge are doing pretty good. But I love this ETF, man. Let's just take a quick look at Enbridge. Yeah, Enbridge, I mean, is still crushing it this year, 6.3% yield. But when it comes to these banks, I really like the fact that the VDY gives me the best exposure to them without me having to buy all of them individually, or buying a very fixed ETF that only focuses on the banks. So I'm going to keep buying VDY. I'm going to set up a drip on this sucker. I pretty much already got all of this set up, and I'm going to be focusing more on the savings accounts and GICs in the midterm here. But I would definitely be taking a look at the banks. This is an incredible opportunity, and now is the time. I'm telling you, you're going to regret it. Come back to me in a year or two and tell me I was wrong about buying the banks in the current market environment. But stay cool, stay awesome, and as always, folks, I look forward to catching you in the next one.